Good afternoon and welcome to the Post-Monetary Policy Committee press conference. The Monetary Policy Committee held its meeting yesterday, the 29th of September 2022. And as is usual, we are having our press conference today addressed by the Governor of the Central Bank of Kenya, after which we will be able to take your questions. You may send your questions through on Slido. That's www.slido.com. And the meeting is hashtag Mpc 0922. Without further ado, I'd like to welcome and invite the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Thank you very much. And first, I have to apologize for what happened this morning. We ended up having some technical issues, and the sound wasn't carrying through, and it took a while to fix it. And so apologies for that. And we hope that this will be satisfactory, and you didn't have to do too much in terms of break all your other schedules. So again, my apologies for that. I'll very quickly cover the same ground as I did this morning, but I'll go a little faster, not because of anything, but also more conscious about the time of day. So just being a bit faster on the presentation. The presentation today really comes after the MPC meeting, and we are trying to give you more detailed information as to what underpinned the decision. You've already seen the press release, which has been was circulated yesterday with the specific decisions. But the first thing is the global developments. And here, we have witnessed a dramatic change in fortunes in the global economy since the last meeting. Inflation in advanced economies has increased dramatically and pushing 10%, double digit. And you have the graph there that shows you some of the numbers. EU at 9.1, UK 9.9, etc. And this is across all advanced economies. And in particular, Germany, just yesterday they put out some new numbers for September, and they were at 10.9% year-on-year, a 70-year high. You have to go back to 1951 to get them, or to have a double-digit inflation number in Germany. So the point here in 1951 is post-war, just right after the Second World War. And at the same time, there are warnings about deep recession and impact of the gas shortages on the respective communities in advanced economies and Germany in particular. So this is a big concern, as we have said before. Supply chain problems were the first ones that were pushing inflation. And then you had the fuel issues, and now gas, so fuel and gas. Of course, the war in Ukraine has also helped push some of the prices up because of lack of availability, etc., etc. So, but what happened is the policymakers in advanced economies, they have now appreciated the cost of their slow action related to dealing with inflation, and they have hastened to address this concern before it gets entrenched in their economies. And that means that there have been significant, and they've also telegraphed significant increases in their benchmark interest rates going forward to deal with inflation. Now, the delay in their action has been costly, particularly with respect to their credibility. And what happened, as you know, in September 21, the Fed, US Fed, announced a 75 basis point increase in their benchmark rate. And this sort of sent the markets into turmoil, into the equity markets fell, volatility surged, etc. That's just one example of the very strong market reaction, which should, in normal circumstances, would have been much more muted, meaning the markets have already priced in the expected increase in rates, etc. But no, it was just the contrary. It created volatility as opposed to reducing volatility. So financial market turmoil, not a tantrum, now we are talking turmoil, seems to be the flavor of the month. Strength of the US dollar is a key element here, and we have a flight to safe haven, the US, but also because the US was the one that was ahead in terms of raising interest rates. So there was a flight to the US from all other, let's say, jurisdictions, but in particular the emerging markets. At the same time, therefore, there has been that outflow of capital from the emerging markets, and also difficulties being shut off, let's say, from the capital, the global capital markets. More recently, last Friday, a week ago, we also had this experiment in orthodoxy, or rather unorthodoxy, or unorthodox policies. The UK Chancellor of the Exchequer announced unprecedented and funded tax cuts, which obviously would have had significant impact on the borrowing, etc. And the markets obviously reacted violently. And that is just to put it mildly. And there was a lot of seesaw of policies, as you know, by the Bank of England, the central bank there. And in the end, there were serious concerns about financial stability, which the Bank of England had to deal with. Obviously, it's not over. There's been a respite, but at the same time, one would expect that this matter will be dealt with in a sort of a comprehensive way, so that the policies are not incoherent. And in particular, we are concerned, of course, that all those actions in those markets have considerable spillover effects on our countries, on our economies, emerging market and frontier economies. And so that is a big concern for us. We are not just innocent, watching from the sidelines. No, it affects us deeply. Now, of course, most of these things have been self-inflicted, the damage, but then we have the spillovers. At the same time, we should not just sit and encourage the advanced economies to do the right thing. Sure, we will encourage them, and we have encouraged them to do the right thing. But I think the point here is that we too have to take action that would strengthen us, strengthen our macroeconomy. Stronger policies are a source of our resilience. So it's against this backdrop that of global developments, negative developments, that actually the MPC made its decision, because it's clear that all those will lead to pressures, or let's say imported inflation, towards us. At the same time, there is the positive elements, which we are going to talk about in a minute. First of this is oil, the crude oil. The prices have come down, and that slide shows you've seen it before, where the prices are today. Well, actually 2 days ago. And this is the Marbon oil. This is September 28th, just 2 days ago. And it's at $89 a barrel. And we would hope that this will continue going down. Now, it's true, right at the end there, it's going up to 89 from 81. But I think the point here is that the general direction is the right one. And we expect that the actions that other countries have done, the US in particular, will help continue pushing this lower. Secondly, global commodity prices have been improving, have been falling, moderating. And here is a graph that we showed you last time of some specific commodities. Palm oil. Remember, palm oil, it's used for various things, making edible oils, making soap, etc. So it is a big ingredient to those sort of things. And you can see it has come down dramatically. And then the other commodities there that you can see will circulate these slides on Monday. Then, of course, another slide is about relates to the supply chain pressures. This is the cost of freight. This is a 40-foot container. How much does it cost in US dollars? I believe this is an index standard index. I cannot, yeah, so you can see it was below 2,000 for quite some time. And then during the COVID period, that shot up to, more than 10,000. And now it has moderated. We are at the 6,000 range, a little below that. And it's still high relative to previous what it was in 2019. But I think definitely this has, it's going in the right direction and moderating. So those are the things I wanted to mention in terms of the global developments. So closer home, domestic economy. Now in May 2022, we did mention, we warned of a clear and present danger of breaching our 7.5% threshold over the next 3 months. That's the inflation, the CPI inflation. And in fact, it came to pass. So in June, July, and August, the CPI numbers have been above the 7.5 threshold. Now it's true in May we did take action and raised our benchmark rate by 50 basis points. And also there was a raft of government measures that were meant to moderate cost of living concerns of the population, and all those including, for instance, on the electricity, on fuel, on UNGA. All those, we listed them in our press release of July. So that notwithstanding, the August print, the August outcome was 8.5%. And as you can see here, food inflation was at 15%. And fuel was at 8.6%. And indeed, non-food, non-fuel was at 3.2%. Now, if you look at the contributions to the 8.5, you'll see that food was the largest contributor. So the 8.5 percentage points, 5.5 was from food, and then 1.9 was fuel, and 1.1 was non-food, non-fuel. So the question then is, what is happening with food? And I think here is a good slide that shows you there are 4 items: wheat, maize, milk, and edible oil. All of them, if you look at the contribution of those 4 in the 8.5, actually they contribute 3.2, more than a third, 3.2. So 3.2 percentage points on the 8.5. So the point, of course, is food is a significant element, and we expect that the various, let's say, trends in food, we already talked about edible oil in the context of the palm oil, etc. Those are coming down. Wheat also, I think we showed that slide. But I think there are also domestic things, domestic considerations, right? The wheat, the harvest, the maize harvest, etc., and obviously other non-vegetables also coming into the market and so forth. So the food item, we expect that will moderate in particular ways. At the same time, we expect that fuel, if you remember, there was an increase there's a removal of the subsidies on petrol. And that will obviously push the inflation price up, both for this month, the month of September, of which we expect the numbers today, and indeed going forward. So it is on this basis that the MPC made its decision. So in sum, having looked at the external developments, having also looked at the trends on significant contributors to inflation, the MPC thought it wise and decided to deal with the emergence of inflation, particularly the second order effects. It's true, one can say, what has monetary policy got to do with the price of vegetables and etc. But I think the point here is the second round effects. So things that relate, let's say, the things that relate to those specific products in a second order way. So think about fuel and think about transportation costs. So the cost on transportation, that's a second order effect. And that's why the MPC took the action that it took of increasing the benchmark rate by 75 basis points. Again, I say that we're expecting to see sometime later today the release of, by the Kenya National Bureau of Statistics, of the September inflation numbers. Moving on, domestic growth. We have not revised the projections on our domestic growth, or rather the growth of our economy, so domestic economy. And this is a slide you saw last time. And I think the only thing we've done here is to update the information with respect to the leading indicators. And so we are still projecting for Q2 a growth of 4.7, or a number around 4.7%. And that's the Q2 growth. We already have the Q1 growth of 6.8. But I think the point here is that we are also seeing a very strong or resilient growth, resilient economy in Q3 and Q4. So as we go to the end of the year, that means we are now projecting growth of 5.4% like we did last time. And we expect also that the Q2 data will be released hopefully today, but definitely in the near future. We expect this to be released shortly. It's true, we also expect the IMF to issue its global, or its projections for global growth in the next maybe 10 days or so. And on that basis, on the basis of the Q2 data that the KNBS will release, IMF data and all other data, including our leading indicators, we will revise the growth number once we have all those in. But at this moment, we are still projecting 5.4 for the year and 4.7 for the quarter, which indeed is a strong growth given the circumstances that we are in, a very weak global economy, and also all the other concerns that we have had in this domestically, including elections, etc. So I think the point here is that there's a lot of dynamism, or should we say resilience, in the economy. So that's what I want to say, but I think we can cover a few slides that show the specific, some of the specific, let's say, indicators that have been tossed in the leading indicators. This is on wholesale trade and manufacturing sector. So you can see the wholesale trade, the growth, the green bars are the year-on-year. For month of August, for instance, 9.3 relative to August last year. So the turnover, so significant improvement. And that is if you want levels, that's the blue line at the top, right? So manufacturing as well, 10.4% growth. This is, and remember August also was a year when there was a lot more electioneering, as we called it. So in some sense, the sort of the lower growth in July, August is well understood, but these are still very healthy numbers. Power consumption, again also, this relates to, particularly on the large power consumers, relates to industrialists, etc., large movers of those products. And I think this also, you can see the economy has been growing if you use this as a sort of an indicator of the dynamism of the economy. The cement consumption, this, you can see a decline of about 12% in July and a decline of 17% in August. Consumption and production, similar declines. Well, the point is that this coincided with, or rather this is as a result of the completion of some of the large infrastructure projects that were there. The expressway, for instance, the Nairobi Expressway, and also the construction of the, I guess it's a bypass around the airport and port of Mombasa, I don't remember what the name is, but I think we understand that large project, which was actually commissioned recently. So those were two significant projects that had a lot of consumption, and hence one could see this decline. But there are also other projects, obviously, that have been completed. Turnover on transport and storage, again, these are good numbers. Now, we'll talk about transport and storage in a little while, but I think also you can look at accommodation, food, and services. Those are the restaurants. 37% increase in turnover. So and I think this is something that we have all seen, that the hotels are now doing better, etc. Having said that, private sector growth at credit growth, or credit to the private sector, 12.5%, has moderated from 14.2, but it's still significantly higher than, say, what it was in the earlier in the year. So again, shows that this is going on. If you look at the sectors, some leading sectors in this, you have manufacturing, trade, business, and also consumer durables. Consumer durables is an interesting one because it shows the consumers, let's say, private sector confidence level, if you want to think of it that way. So what is the level of their optimism, etc. You know, so that is an important indicator, as you can see. Other slides. We move to the surveys. This is something that I would encourage you to look at. Again, the surveys are producing very good data, good information. They are surveys as such, surveys. So we ask CEOs in this case and other actors specific questions. We hope to put them out on Monday. On our website once they're all ready to be put out. But anyway, here is the, no, go back please. So this is a measure of business confidence, right? And this is by CEOs. And so you ask them how confident are they about their company, you know, the optimism in that things will be better. And you can see that between July and September, there was a significant increase. So if you look at the ones that think that things will be worse, that was 22% in July, now it's only 11%. Now, sector as well, so asking them about their sector, you see that that has also improved appropriately. I'll let you look at this also when we put out the slides. Next slide is from Market Perception Survey. And on the left-hand side, you have banks as respondents. And on the right-hand side, you have non-banks. And you can see banks, if you ask about the level of optimism, you can see they are at 94% that are optimistic, either optimistic or very optimistic, right? And on the non-banks, you have similar levels of improvement from July, from the July survey to September survey. This shows you the dynamism that the private sector is feeling, right? Obviously, this has to be realized, but it is important to appreciate that you have to start with optimism. Next slide shows us from a different perspective the same outcome, but now looking at it relative to July and looking at it from, let's say, what happened in 2017, the last elections. And you can see that 2017, there was a significant increase in optimism from July to September, but you can see that it is completely dominated. It's completely dominated by the September outcome, September 2022, right, at 94%, and also on the non-bank side. I'll let you look at it when we put it out there, but I think all these are pointing to significant private sector or optimism by the private sector about Kenya's economic prospects going forward. So another interesting, let's say, piece of data from the survey is forward bookings in the hotels, right? Now, this survey was done in September. So let's look at December, so 3 months ahead. Already in Mombasa, we had 60% booking, that is of bed capacity. In Nairobi, we had 50%. And rest of the country, we had 58%. My point here is that this is remarkable in terms of forward booking, or forward bookings at this level. It shows a lot of optimism in the country for people to make those early, let's say, plans for 3 months ahead, etc. You look at more data that is related to this in the survey. This is there are 2 slides that are here on the agricultural sector survey. We have started, as you know, a new survey of the agricultural sector. And it tells us there's a lot of detailed information that it is kicking up. I'm not going to go through it, but I think I just wanted to show you this as a teaser, because we are getting good information about from the respondents, farmers, traders, etc., about, let's say, what they expect in terms of prices, what they expect in terms of volumes, and what their concerns are, etc. So I don't want to go through it in detail now, but I just wanted you to know that there is significant information that you could come back to in this now well-structured agricultural sector survey. So this was one slide, but there was a second one which we will show you at that time. Then we move on to the balance of payments. And the balance of payments, exports have remained strong, have been growing strongly, 11% generally relative to a year ago, or rather the same period last year. And I think the points, if you look at all the products, there's strong growth. The only one that you can see that has been, let's say, has fallen is horticultures, and I think we explained this the last two meetings that we had. And this relates partly or largely to the export of avocados. And now those problems have been resolved. And indeed, all we are hearing is actually the converse, which is there's a lot of exports to China, and others also are interested in purchasing our avocados, etc. Imports, similarly, have grown dramatically. And I think the point here is they have outstripped the growth in exports. And if we were to talk about what was driving it, I think one product only, oil. So for the same period, it was at 2.8. We imported 2.8 worth of oil, petroleum products, and a year ago, and now it was 5.2, so significant increase. The others are much more moderate. Now you break this into by type of imports, consumer, capital, etc. Obviously, a lot of it you see is intermediate imports, and if you do intermediate imports, excluding oil, you see that is more reasonable, from 9 to 10.3. So significantly in all this, oil is the one that has really pushed pushed the imports to outstrip the growth in exports. This is a rather busy slide, but I think I just want to say travel receipts, you can see it improving related to the volumes, but I think the more interesting one for me is the transport receipts. And this relates to things like hauling, KQ Airlines, etc. So what others pay us for providing transportation services, etc. And I think this one has been growing quite strongly and worth watching. It relates to your haulers, etc., who are moving stuff cross-border, etc. Moving along, this is the tourist numbers. I'm not going to talk too much about it, but I think we can see that it is increasing. Remittances, again, this is a number that we are familiar with. So far, 4 billion, relative to 3.4. All these numbers are for the period for 12 months to August. So it's comparing likes to likes. So they are not annual as such. But anyway, meaning calendar year. But anyway, so you can see the growth. It is true in the last couple of months, if you look at the monthly numbers, the numbers has been soft. But there are two things that are driving that. First is very strong seasonality, and we have seen it before, not just last year, but anyway. So this seasonality, and we expect, according to the seasonality, the next quarter, that is the quarter that begins tomorrow, October, there'll be a sort of a reversal of that, and it'll be an increase towards Christmas, etc. The other thing is obviously the diaspora, the people, the remitters, having their own cost of living shock. So one could expect that they have to adjust their, let's say, their budget to accommodate some of the remittances that maybe they will be doing. So those two elements are there. But I think the point is diaspora remains strong, and we expect that to continue appropriately. Current account, the current account balance, that remains, it's now at 5.2% of GDP, and this actually is the same level as it was 12 months ago. So this chart is not like the one I just mentioned a moment ago. This until 2021, those are calendar years. And then the year to August is 5.2. If you had year to August 2021, it would have been 5.2% of GDP as well. And our expectation is this will be at the end of the year 5.9, as we have mentioned before. Of course, we will recalculate this once we redo GDP, etc. So it will be a package of numbers that we will do. Moving on, so current account, but I think the point here is that the current account, as I have said before, at around 5%, that is our sweet spot. It's reasonable because we can finance that in various ways, portfolio investment, the FDI, etc. So that can be well taken care of within our capital account. Having said that, we ask ourselves, what about the exchange rate? Now, here you can see on the left-hand side, this is major currencies versus the US dollar. And you can see on the left-hand side the dollar index, which is dollar versus a basket of leading currencies in the country, in the world. And you can see the dollar has appreciated by 18%. That's significant, 18%. I explained why it has appreciated earlier in my presentation. And so most of the other currencies have depreciated. And you can see that's what has happened from the yen to the pound, etc. I think this is something that we would not ordinarily see. Such large numbers. You're talking double-digit depreciations of leading indicators against the dollar. So I think the point here is that the dollar has been driving everybody, every currency, and in a sense, we are not unique, meaning there's no place to hide. Moving on to the currencies that are closer to us, and that is around Africa, you can see that similarly, there are some currencies on the left-hand side, the greens, Angola, Botswana, Zambia. I think we can just say that if you want to understand Angola, currency movement in Zambia, I would suggest you look at the last two to 3 years, because particularly those two, there are significant depreciations that took place. So this is sort of like a resetting somewhat. But notwithstanding, you have the other currencies sort of towards the right, from the SEDI to the all the way to, as you can see, we are at 6.7%. Again, we are in the middle of the road, yeah, or middle of the park, which is perhaps the best place to be, given these very uncertain times and given the huge movements that we've seen. And that's, so in that sense, we feel quite comfortable in terms of what is happening in the FX market, meaning the pricing or the exchange rate that is the market is producing. We are reasonably comfortable with that. Having said that, the foreign exchange reserves, and I think the point here is that we are at 7.4. This is our own reserves, 7.4, which is about 4.2 months of import cover. And yes, so we have reasonable reserves here. We have adequate reserve cover. And again, remember, reserves are to be used sort of on there's a rainy fund, kind of rainy day fund, if you want to put it that way. So to be used in those sort of horrendous sort of situations. But I think the point that maybe some of you have asked before is, but okay, Governor, you've mentioned several times that there is adequate foreign exchange. But is that happening? And my answer would be, yes, I had made the point that we have, and I continue to make the point that we have adequate foreign exchange. The point is that the markets need to improve in the way they are functioning. And yes, there was noise in the market as we came towards the electioneering period, etc., those 2 to 3 months. And that also obviously led to a sort of a, let's say, weaker performance of the market. Now we are talking the FX market. Now that all that has been, let's say, resolved, meaning the electioneering period has ended, the political, let's say, noise and risk has come down dramatically. Those uncertainties, COVID as well has come down. Of course, you still have the external issues that I mentioned a moment ago. So we expect that actually will bring us back to, to a sort of, will bring us back together, as it were, and continue to strengthen the market. Next slide is about the performance of the yield curve. And here I would say, or performance of the government security market. And all I would want to show in this is that there's a well-defined yield curve, correctly sloped. And you can see also the time to maturity of the various instruments as shown there. The point here is that the government securities market has continued to function well. It is true there has been significant, let's say, lack of liquidity or reduced liquidity in the market. And the reason for the reduced liquidity partly is because of the government's own, now they are not spending as much. But I think we all understand there's a lot of, as we come to the beginning of the year, there's a lot of holding back of expenditures, meaning it's a pretty dry season for expenditures as the various approvals are done. And now even more, because there's now a new administration and they need to sort of understand what they're spending on, etc. So a sort of a regrouping, if you may. But I want to just make the point that the government securities market has been functioning okay. I think that's it. There could be other questions that I would encourage you to ask, but I think for now, I think I have, I even overshot my, my target, as it were. So thank you very much. I look forward to your questions.
Thank you very much. That was the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge. And we will jump straight into the questions. We'll begin with Kefa Moirore of Radio Citizen. Kefa says, trying to read the MPC's mind, what were the trade-offs in the decision to lift the CBR over a pause? He adds that expectations were largely split in the middle. A second question from Kefa. Last year's freeze on CRB listings relapses today. In light of the reforms to come to credit scoring, has the CBK issued directions to extend the freeze? Finally, for this batch from Jimmy Mbogo of Business Hour, what informed the CBR rate increase, and isn't this going to increase the cost of credit?
Okay, thank you. So maybe beginning with Jimmy's question. Jimmy, I think I've explained sort of what informed it, the risk that the MPC saw of a sort of a increase in the inflation outcomes, or worse inflation outcomes, and also unhinging of inflation expectations. So in that sense, it was important to deal with it. It is true, it may lead, it operates also by increasing the cost of credit, that is sure. But I think the issue here is what is your number one evil? Yeah, what is it that you're dealing with? And inflation is the number one evil. In this regard, we've talked about it in the past, and I'm sure you have written about it. I mean, many of you must have written about it somewhere to your readers and etc. Because among other things, inflation hurts the weakest the most. So I think in some sense, it is important to appreciate that it is not just a number. Inflation is not just a number. There are lives, there are people behind it. And often there are those that have the least ability to maneuver are the ones that are hurt the most. So that's why it is so important to bring inflation back in the box, as it were. And then once it's there, then long-term issues, including the issue of cost of credit, will be dealt with. Remember, we've come a long way. We've talked about this before, where there was significant, not just inflation, but other things that led us to take certain harsh actions because we knew what our priorities were. So here, inflation is the priority, dealing with it, and making sure that inflation expectations don't get embedded in our thinking, etc. Now, Kefa also asked the trade-offs. I guess I've explained this, yeah? You said to lift of our pause. Well, the pause means that we are doing nothing, meaning the set of policies that are there are appropriate for the problem, to deal with the problem. And that is what I'm saying, that the MPC realized that that was not the case, that there was scope, according to the press release, there was scope for a further tightening of monetary policy to deal with the risk of higher inflation. And so in a sense, we did what we should have done. When we see inflation, we have to deal with it. What we cannot do is to sit and sort of pretend that it's not there, or for that matter, say, wish it away, or sort of say, well, for sure it will be temporary. You can use whatever word you want for that. So I think in some sense we saw the danger and we have dealt with it. And if indeed the inflation monster is killed soon enough, then we'll reverse policies. Maybe at that time, if it is more accommodative policies are needed, we'll evaluate it. But here and now, the assessment was one of tightening of policy. Kefa also asked about last year's freeze on CRB. Well, maybe I should say a few more things here, which is, it is true we have this CRB process, Credit Reference Bureau, but actually it has a different label, but in it, let's use the label CRB. I think we understand each other, yeah? And I think it has been a significant step forward in the way we do business. We'll never manage to do adequately the risk-based pricing of loans if we don't have this well done. And I think when we started off, there were significant difficulties, including what has been a sort of a use of this as blacklisting. So you're blacklisted and boom, you're out. Now, 2 years ago, we enhanced it and we improved it in particular ways, and I hope some of you have looked at the progress that we made at the time. And it is true, we froze some of the, let's say, uses of it in the context of COVID. COVID is now behind us. I mean, most of us, I mean, it's true, we're supposed to wear a mask, but everywhere I go, you know, I'm the only one who's wearing a mask. So I have to remove my mask, otherwise, you know, so I think the point is that now is behind us. Of course, what we need to do is to, as the president has indicated recently or suggested to us, requested us to look into this so that we can improve it further. And that is something that we are doing. So please be patient. We will improve it. It has to start from where it is, meaning where it is operating in a particular way, and we will improve it so that it becomes an even better tool for you, the consumer, or rather the consumers, regardless of where they are on the sort of, let's say, range, range of, let's say, adequacy of financial management, right? So I think that is really the point I would want to make, but I again plead for your patience. We will be looking at it again, and well, we are looking at it, and we've been looking at it, and we hope that the outcome will be something that will, obviously we also want to say we want to benefit from other countries, the experience of other countries. By the way, we have done a lot of that work already, meaning benefiting from other countries. So I think give us some time.
All right. In the second batch of questions, we begin with Rama Nyang from CGTN Africa. Rama says the governor has spoken about persons trying to execute a golden bug style scam in the foreign exchange market. Who are they and what action has CBK taken against them? Jimmy Mbogo again from Business Hour. Are you concerned about the plan to increase the limit of 1 million shillings withdrawal and deposit and its effect on anti-money laundering and counter-terrorist financing? Johnston Oleturana from QLand Media is asking, yesterday the president instructed spending be cut by 300 billion shillings. Banks will have to increase lending to the private sector. How will this play out on inflation?
Thank you. So first question, Raman's question. Yes, in my presentation to members of Parliament on September 19, Monday, September 19, I commented on record hearkening back to Golden Bug. Raman, I'll leave that there and will not comment further. On the question that Jimmy has asked about the 1 million limit, I think the point here is no, I'm not concerned because maybe it is not, what you're asking me is probably much wider, yeah? I don't think there's any plan to increase the limit. And if there was any plan, I would know. I think we have had discussions and we continue to have discussions about improving the way that whole, let's say, KYC, know your customer, and cash management, so as to ensure that the anti-money laundering and CFT, combating financing of terrorism, parameters are dealt with correctly. The point, though, is that the way it is done today, there are a lot of concerns from a customer perspective. There are many pain points, and we have actually looked at it carefully. We've done some surveys on this, actually much earlier. We did them in January through March, I believe, maybe April of this year, and in a sense, detailed some of the concerns. So the point is, those concerns need a solution, and that is basically what we have been told, we have been seeing, and the president has recently talked about those, and we have indicated that we are working on them, and we will have a solution that is appropriate, maintains the the protections that need to be there on anti-money laundering, AML-CFT, but at the same time removes the pain points that consumers obviously feel, etc. I mean, some of them are, let's say, implementation issues, right? So you go to a bank and deposit in some money, and it's the same bank, different branches. There is a a different approach. So I think the point here is we understand that, and we need to deal with it. It is a true concern that we have to deal with. Then Johnston asks about the president's statement yesterday relating to cutting back expenditures by 300 billion Kenya shillings. I think this is something to be applauded, and we look forward to its implementation. Why is that? Maybe we show you, some time ago, we showed you the consolidation path that we have been talking about, right? I showed this slide to the parliamentarians on the 19th. Give me a bit of time. There it is. The slide is there. So the reds are the actuals, okay? So this is a budget deficit in the context of as a share of GDP. You generally would standardize this by GDP. And you can see in 2021, right? The deficit, this is in the midst of COVID, the deficit was at 8.4. That increased from 7.8 to 8.4. And the target actually at that time for us, given COVID, etc., was 8.7% of GDP. In effect, last fiscal year, 21-22, it came down to 6.1%. Again, the numbers are to be confirmed completely, but it will be around there, 6.1. So a consolidation from 8.4 to 6.1. It is true, there are some pending bills, etc., that in a sense make the 6.1 a dirty 6.1, so the National Treasury will have to adjust their numbers appropriately. But the point is that the direction is significant. More than 2 percentage points of GDP. That is significant. So at that point, before COVID, we had a certain path that we had accepted as a people, as a country, and that was the dashed boxes, the black boxes. So that was the consolidation path that we were at. But now, given COVID, we revised that to the green, right? That is the green. Now, given where we are, we could probably say that we need to move to something like 6% in fiscal year 22-23, right? The next fiscal year. And but I think the point is that is being discussed, because precisely that 300 billion Kenya shillings will reduce that deficit from where it is now. So that number, 6% of GDP, is the one that actually will probably be shorter. What does that mean? Or smaller? What does that mean? It means that we'll have a faster consolidation, faster fiscal consolidation. We've had conversations with you about the debt evolution of debt. And I've made the point repeatedly, not once, but repeatedly, that a key element in debt consolidation and bringing debt under control is actually credible, sustainable fiscal consolidation. So there you have it. So to the extent that we have a sustainable decrease in the deficit, that will bond well with strong, let's say, sort of a reversal, or more than reversal, sort of bringing debt, the path of debt back into a sort of a sustainable line. So I think I want to leave it there. Of course, it will lead to a reduction in the borrowing requirements, right? In the borrowing requirements, and that is okay. The private sector, it's not that the private sector was crowded out, but I think the point is that we are in a position where the banks should be lending, working with individual producers, etc., on their things. So I think that is good. That is good. Will it play out with inflation? Okay, obviously this works positively in terms of inflation, meaning it is not inflationary. If anything, it's deflationary. So it will support the inflation path that we are doing, meaning reducing the prospects of high inflation.
Faisal Ahmed from Citizen TV has said, Central Bank of Kenya received any queries from First Community Bank customers regarding liquidity challenges at the bank? Eric Mokaya from Wango Capital, a follow-up on your recent comments about Safaricom. What is the proposed path between now and January 2023 in regards to splitting it? And we combine that with Ramanyang from CGTN Africa, similar question. What material difference will CBK have in regulating M-Pesa as a separate legal entity rather than in its current form as part of Safaricom? Finally, from David Herbling from Bloomberg News, do you plan to serve the full remainder of your term as CBK governor, or are you mulling an early exit from office?
Okay, so Faisal, I think those questions about the bank, etc., no, I cannot comment on that, but I think the point is that all the banks that we are working with have access to, in case of liquidity needs, they have access to significant instruments, both in the central bank and also in other places, meaning in the interbank market, with their own bilateral lines with banks, etc. So I think the point there is all banks are working to, let's say, deal with any liquidity, or should we say any of those challenges that may happen from one day to the next. I'll take Eric and Raman's question again together. I think the point here is that I know you're referring to comments I made about when the parliamentarians asked me about Safaricom, and the previous, I guess is the 12th parliament, was intent, and there were many questions about, or many discussions about breaking up Safaricom, etc. And our point here is that we need to improve the governance of this institution, an institution that we regulate. And it's not the only institution we regulate, but I think the point here is that we have a path that we are walking with them, and at the right time it will be presented. So I did make the point that let's ask me that question. So I told them in January, and the point was just to say that we are working on this in a sort of a short term, in the short term, rather than in the months and years sort of horizon. So I would just leave it there and sort of ask you to bear with us as we deal with these issues. Bottom line is to make the institution stronger. Stronger in terms of governance, in terms of ability to deliver to the consumer, in terms of ability to maneuver in case of shocks, etc. So I think the point here is clear. And we have done that with banks. There was a time when banks were all one basket, right? One group. And then we have kind of sorted the space, and I think you can see the benefits of that. David Halbring asks, I think, David, on your question, I would probably say it's probably best directed to Trevor Noah. So I'll leave that there.
The final batch of questions, we begin with Herald Allo from the People Daily. Are there possibilities of CBK starting to regulate BNPL, I believe that's buy now, pay later companies, and Shylock businesses? Eric Mokaya, again from Mango Capital, on the licensing of digital lenders, since you approved 10 of them, what is the current status of the other 278 applications that were made but have not yet been approved? And finally, from Victor Amadala of The Star, the private sector is hurting from over 500 billion shillings of pending bills. The president has ordered budget cuts. Will this not further strain economic activities?
Okay, so first, Herod, the buy now, pay later. Basically, we are, maybe to put it differently, the entire financial sector, we are believers that given the experiences in other countries and ours as well, it is essential to regulate financial institutions. I don't think there's any two ways about it. It's just like doctors, it's just like pharmacists. If you don't regulate them, the social costs are significant. So that is the starting point. Whether it is regulated by the central bank or another institution, that is an issue of the here and now, etc. But what is clear is if these companies are digital credit providers as so defined in the Act, then we regulate them, right? So this is probably like a product that you're talking about. Now, remember there are many other, let's say, even there used to be the hire purchase, remember, that were regulated by somebody else. So there are many other actors in this space. But I think at this moment, we are really making progress on the digital credit providers, which is where the largest social pain was. The largest social pain. And I think you know this. We talked about this before. The social cost, people, let's not repeat those points, but I think it is clear. So I am really looking forward to sort of finally dealing with all these credit regulators and credit providers that use the benefit of the telephone and then provide you with credit and then end up harassing you in all sorts of ways. So that's what I want to say about that. But Eric also asked about it's true we approved 10 and there were others, there were 288 that we had in total. And so the others were at different stages in their in the process. And as we said in the press release, we urge them to quickly deal with the issues that we had pointed out to them, right? There are different issues, each one specific to what it is. But I think the point here is we will not provide them with a license unless they actually adhere to the specific requirements that is required in the Act, etc. One of the things that I think is very clear is that we need to be clear about how they deal with their customers, right? An assurance that their collection habits or methods are ethical, all those things. So in a sense, one can make the point it is their business model that we are interested in. One of the many things, business model. One could also say things related to the source of capital, etc. Also to understand who are the people that are running these operations. These are all requirements that should be standard. And I think I just encourage them. Thanks, Eric, for giving me the occasion to remind them to do what they need to do quickly. Let them resolve those issues, come back to us quickly, and we can then move on with licensing them. Victor asks about the pending bills. Well, I don't have the number, but you says 500 billion pending bills. And I actually think the pending bills has been a significant problem, as everybody agrees, because, you know, if indeed, let's say, a road or a particular project is worth, what, 10, let's say, or even 100, let's say 100 million. And the contractor or the vendor begins to calculate how long or to incorporate how long it will take to have them to actually get paid, meaning going through the pending bill process, et cetera, et cetera. Obviously, the specific vendor or contractor will not charge you 100, so the county ends up being charged, what, 150, right? Just because of that pending bill syndrome, if it gets entrenched in the way we do business. So it's a very big problem. And at the same time, of course, you know, during that period, the company doesn't have resources, it doesn't have liquidity, etc. So you could even actually it could even collapse, send it to bankruptcy, just because of the pending bill problem. So I think it is extremely important, and I think all of us, the president has made this point, that this is something that needs to be dealt with. I think at the same time, making sure that we don't create new pending bills. So it's one thing to have the stock and deal with the stock, but we need to make sure that there are no new pending bills, you know, so that will end up going into that bucket. So thank you, Victor, for your question. Anything else?
That is it in terms of the batch of questions that we had. There were quite a number today. We thank you all for joining us this afternoon, a bit later than we usually do it, but we thank you for having been with us and putting through all your questions. As the press release says, the MPC will meet again in November, but is obviously prepared to meet earlier should the circumstances warrant it. But for now, thank you, and do have yourselves a good afternoon and a good weekend.